Yeah, they're super important. This kind of education right here is going to educate the buyer so much on like what these things are, and you have to know about all this preemptively, because when you find the house you love in this market, it's going to be gone instantly. So you have to move very, very quickly. 1 week market time is what we're seeing right now. So be prepared, be educated, and try to put your best foot forward.
What's going on, everyone? My name is Edward Espos. I am a mortgage loan originator based in Napa, California. Here with me today is Ryan DeAmaral. Did I get that right?
All right. That's right.
Thank you. He is the owner and broker of Twin Oaks Real Estate in Benicia and in Walnut Creek, servicing the Bay Area in California. Ryan, do you want to give a little intro about yourself?
Yeah, so I'm broker owner of Twin Oaks. Right now we have about 145 agents that I oversee. Started in Benicia. That's where my office is and kind of where I stay, in this little room, and just out of production for the most part myself. So yeah, just helping my agents build their business, and that's what I do.
Awesome, thank you. Yeah, and today we're going to be talking about the home buying process in 2022 and how it's looked this first quarter. So last time we were talking, the big thing was contingencies. And Ryan, can you explain what a contingency is for the audience?
So a brief description of contingency is a contractual right that a buyer has that basically protects their EMD. I mean, that's probably the best way to explain to a buyer. You have a contingency saying that, like say inspection, appraisal, or loan contingency are the three most standard contingencies. You put an earnest money deposit into escrow, and your deposit is protected while you're doing investigations or doing other contractual obligations. Mm-hmm. And yeah, just kind of protecting your deposit and giving you a way out or a renegotiation right on a buyer side.
Gotcha. And Ryan, typically how much is, or how much percent wise is the earnest money deposit?
Yeah, that's a good question. Actually, we were working on part of our university yesterday, and we had some old verbiage in there. I mean, if you're checking liquidated damages, max liquidated damages can be as 3%, typically 1 to 3%. I know a lot of agents kind of just have a template where it's like 1% standard, and it's a negotiable factor for sure. So some people don't even ask their clients what they want to put it in as. You should always ask your client and understand what EMD is. But yeah, put your best foot forward if you have it. So I'll explain to a client, I'll say, okay, if you have liquid cash, a lot of people can't put 3% down for a number of reasons. They might be getting gift funds. They might be taking down payment from retirement account or whatever, or they're liquidate all their cash at one point. So they can't even eat or pay their current rent or whatever. So write it at 3% if you can, because it's the strongest looking, it's the most appealing to a seller, but then it is a negotiable factor. So on VA loans, I think the smallest one I've ever written was probably $500, you know.
Oh, wow.
So if the seller's going to agree to it, they'll agree to it. But if you have the cash liquid and especially if you're protected by a contingency, I don't see a reason why you wouldn't want to put 3%.
And then Ryan, going into the contingencies, you mentioned loan contingency, appraisal, and the inspection. Now, could you give a brief overview of those contingencies?
Yeah, I think it's really important to break down contingencies, each one of them separately. And the reason why is we're seeing a lot of people remove all contingencies now. And that's against brokers' advice to be doing that. We always clearly state that out. And I mean, in different markets, I mean, you might get a really pushy agent. This is definitely not how we train at Twin Oaks, but it's like, hey, if you want to get this offer accepted, you have to remove your contingencies, like remove them. Like, you can't advise your client in that fashion. There's humongous risk with doing things like that. And even on a listing side, you really don't want to be saying, hey, we'll only review offers with no contingencies. You should not write a contingency. There's liabilities in that. You can't really say stuff like that. I'll talk about the easiest one first, which is the loan contingency, probably easiest to explain. So loan contingency is basically saying the buyer is going to do everything in their abilities to try to get a loan. And if they can't get a loan, then they have the ability to back out. So say that they had a job loss or just the numbers weren't correct or something like that. It's not a negotiable contingency. It's only one of the big three contingencies that's not negotiable. So for example, say that you waited to lock in, you locked in late, and the rates gone up. Say they went up to 5% or something, and your payment is $3,000. You thought it was going to be $2,800. It's like, oh, my payment's $200. Let me renegotiate. Hey, can I get $20,000 off the price of my payment flow? Like that contingency does not give you the ability to do it. A lot of agents use that loan contingency kind of like as a blanket contingency. Like, oh, if I have a low contingency, I can kind of back out no matter what. Like that's not the way the contingency is supposed to work either. Like a lot of people will rely on low contingency to back out due to findings they find, even if they don't have an inspection contingency. Unethical to be doing that and not how the contingency is supposed to be used. But I advise my agents, whether they're on the listing side or the buying side, if they have a contingency, they basically have a way out, especially a loan or inspection contingency. Appraisal is a little more like cut and dry. Yeah, that's why a lender is part of our team. So we're a team. It's the lender, it's the agent, and it's the principal, the buyer. So that's why I'm a big advocate for local lenders, someone you could call and talk to, someone you work with a lot, somebody that doesn't have a humongous amount of like corporate overhead and what they can do. Like some of these really big lenders, I don't even know if I should name drop, say a big bank, you know, they won't even give you like a pre-approval, or they're not going to give you a fully underwritten pre-approval. It might even be like a pre-qualification. And that's going to make it look a little weak. But yeah, get the lender involved as part of your team and say, listen, if we're going to talk about removing contingencies, talk to the lender, see how they feel about removing that loan contingency. Can we get you 100% fully underwritten so we know your loan's pretty much a slam dunk?
And taking out the loan contingency, how does that put you apart, or how does it set you apart from other buyers with that on there? Is it just more like, hey, I'm in it all the way?
Yeah. So contingencies can be looked at like a risk to a seller. So if you have the same offer, say you have the house is $500K and you get two offers only, one of them's for $520 and one of them's at $500. The one at $520 has a loan contingency. Let's say they only have a loan contingency, and the one at $520 has no contingencies at all. That offer might be more appealing because it looks like a done deal. Hey, they're going to put in their deposit per contract. The deposit is at risk immediately, and we know there's not I don't want to say we know there's not a chance, but it's more unlikely that something's going to happen to that deal to fall through. Contingencies are just as important as price. And a lot of times when you get to these crazy competitive offers, say you're in Oakland, it's like 30 offers on a house.
Yeah.
Maybe 10 of them are going to have absolutely no contingencies. And the other 20 have like one inspection, appraisal, or loan or whatever. They're probably just going to review the ones with no contingencies, because they're like a dead deal. Especially when we get into appraisal contingency, the ability to like renegotiate, that's a risk to the seller. So look at that. Those contingencies is as strong as you can make them. You're taking the risk away from the seller and you're putting on the buyer. That's what the seller wants, right?
Okay. Let's go into the appraisal.
Okay. So appraisal contingency has been a big one in this crazy market we've been in, and probably a bigger issue like last year and the year before, because people were paying, we had an increase very quickly, like a 15% increase. It felt like overnight in real estate prices. So comps weren't justifying what people were paying for houses. Yeah. And then it was still at the time where we didn't see like as much of a full contingency removal out here in Solano County, at least. So people were just kind of having to modify that appraisal contingency. So say we're running comps. I'll give you an example of this listing I had in Vallejo. I priced it at what comps said it was worth, which is like 680, kind of in the ballpark of, hey, if someone's willing to pay more, this is what we think you could appraise for, and who knows what it's going to go up to. But it ended up going 100,000 over.
Wow.
And yeah, in Vallejo, that wasn't a super common thing that was happening at the time. So we actually had like 3 that were in that range.
That is
One of them had,
insane.
yeah, one of them had a full contingency removal. One just
Mhm.
had a standard inspection contingency, and one had like a bridge.
A
So
bridge.
yeah, so a bridge is it's now in the new RPA, we can write a bridge in, but the old RPA we used to have to write verbiage. So the verbiage would be um, buyer shall pay $15,000 over appraised value, not to exceed purchase price. And what
Gotcha.
that would mean is if the property doesn't appraise, we'll still cover the difference by $15,000. Removal of the appraisal contingency altogether, saying no matter what the difference is, you're going to pay it. So that's a big like
Okay.
obligation, and a lot of, we're going to elaborate on this probably way more, but the powers within that appraiser. Yeah, I get a lot of agents call me and say, "What do you think it could appraise for?" I told the buyers can appraise for this. Don't do that. That's a humongous risk. So there's always the possibility you're going to get a bad appraisal. Like just say it's horrible. It's $100,000 what it should have even comped for. That buyer is obligated to. So this is another thing. We're pulling the lender in and we're making them part of the team. This is the way I explain appraisal gap and removal of appraisal contingency. I was like, let's talk to the lender and let's find out what your down payment is and your closing costs. So together, those two together, I'm calling them cash to close. So yeah, those contingencies are looked at like a risk. So the no contingency thing is probably the most appealing looking offer. You might, if you have options to look at that, you're looking at that first, even
Mhm.
before the price. But what I was going to say is sometimes the seller is willing to take the risk. My house will appraise at 900K. I did all this work and I'm way better than the house that sold next door. So if you're on the listing side and seller wants to take that risk, they think it's going to appraise, maybe they're going to take
Mhm.
that offer that just has an appraisal contingency because they think it's going to be fine. So I don't want that to confuse you brand new agents out there that are watching this. So that's not something that happens all the time, but be prepared for that also. Remember, we're to help the buyers and sellers, but we love to let them make their own decisions. We're just to supply them data, experience, and stories and stuff like that, and take care of them, but they make their choice. So I don't make choices for any of my principals ever.
Now, the inspection, that contingency, big one. What are your thoughts?
So it's the strongest contingency a buyer can have. It's basically giving them the opportunity to investigate anything in the property they want. I mean, they could do inspections, even if there was preemptive inspections provided. And inspection contingency has to do with everything. So, hey, I drove to the house to see how long my commute would be or something like that. I'm investigating the area. I'm checking if the property is insurable for an affordable rate. Yeah, you should educate your buyer that review this documentation and bid according to what you know. That's a good one. Okay. So
Yeah.
go to your prelim, get your inspections, bid accordingly. If you can get an inspection contingency in there, then yeah, well, you could do your own home inspection. Maybe you find stuff that wasn't disclosed. Your home inspector was better, or they did a home inspection and not a pest report. So you did a pest report, you found $10,000. Then you have the ability to try to renegotiate that with a little more like a clear conscience on that's probably like an acceptable thing. I bid on the property thinking this, and I found out this.
Yeah.
Seller can say no. So that's a competition thing too. And then it's a hard contingency to remove because it's, I mean, you're looking in the property like this, especially like first time buyer, they're always concerned. You have foundation problems, say they didn't have thorough home inspections or whatever. Anytime on the listing side, I'm doing a really good disclosure package. So we're
Yeah.
doing seller questionnaire, TDS, SPQ, all this stuff. So the disclosures, I'm usually doing a home inspection. I'm usually doing a pest report and a roof inspection. If you could provide a very thorough disclosure package and have it available for buyers to review,
Mhm.
you're probably more likely to receive offers without that inspection contingency because the buyer will feel safe in doing that. Breaking these contingencies down like that not only might make a buyer feel more comfortable. Remember, we're trying to make the offer as appealing as we possibly can. It's our job. If that client loves that house, it's our job to get it for them, to put them in the best position to get them that house. So, but it's their risk, So we're educating them on the risk of it, and then it's less of like my agent failed me, we didn't get the offer accepted. It's like, yeah, I explained kind of everything to you, and we made a decision together on what you're comfortable with. Yeah. Any questions on that?
No, that was it. We dived deep, everyone. Thank you so much, Ryan, for your time and your knowledge. It was amazing. If you guys have any other questions, please comment them down below. Like and subscribe for more videos like this. That's it, folks. Till next time, Ryan, thank you so much.